Good morning and welcome to this Monday, January 9th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, as we start another week, second week here in 2023, the bulls will be looking to build upon some gains in the first week. For those of you maybe unaware, the January effect is, well, it's a history of analyzing the performance in the month of January. And then depending on how that performance goes, and I'm talking specifically about the S&P 500, essentially history tells us that the better January is, the better we should expect the balance of the year from February through December. So I can tell you based on my analysis of it, it's a pretty strong indicator. Obviously, it's not 100% guarantee. I've seen some really good Januaries and horrible balance of the years. And I've seen the opposite. I've seen bad Januaries and a really good finish to the year. I think 2009 was one of those years where January was pretty bad. But then that secular bear market ended at the beginning of March, and then we took off. And so the balance of the year was very strong. But those have been the isolated instances where it hasn't worked. For the most part, it has. And so getting into what I've done in my studies is I've broken down Januaries into 4 different quadrants. So the last 73 years, I have the best 18 Januaries in the first quadrant, the next best 18, then the next best, and then finally the worst 19 Januaries. And if you add those up, it'll come up to 73 years. And essentially what I can tell you is that if you have a positive January, just making it very simple, if you have a positive January, and I think there have been 43 of them since 1950, 37 of those balance of years, February to December, have been higher, 37 out of 43. And then I think of the 29 bearish Januaries that have been down, I want to say, well, I'll tell you exactly what it is. Let me make sure I get this right. I want to say it's like 12 out of 19, but it might be different than that. Let's see, of the negatives. Oh, never mind. Yeah, I was way off there. Okay, so 29 negative Januaries, only 18 of those have been higher. So 18 out of 29 versus 37 out of 43. I can tell you the percentage is much, much higher on having a strong rest of the year if you have a strong January. So again, it's not a perfect indication, but I don't know of any perfect indications in the market. This is a pretty good one. And I think a lot of it is that if the market is seeing a good year ahead, I mean, you get a lot of things going on at the end of the year. It could be tax selling, could be usually the fourth quarter is a pretty decent time of the year. But I think after having a cyclical bear market, I think we saw a lot of tax selling at the end of the year. Anyway, that if you turn around and all of a sudden start performing pretty well in January, it's a pretty good sign. So anyway, I just wanted to point that out, at least make sure you're aware of it. Currently futures, and this was as of maybe about 10 minutes ago, Dow futures are up 109, S&P 500 futures up 19, NASDAQ futures up about 70. So on a relative basis, NASDAQ getting off to a little bit better start. Although looking at the last few weeks, even when the NASDAQ has gotten off to a pretty good start on a relative basis, it tends to give it away during the day. That's been the recent history. So we'll see if that changes today. Crude oil up $2.43. So that is trading at $76.20 per barrel. And the U.S. 10-year Treasury yield is basically flat this morning, 3.57%, which is well off of where we were not too long ago, and certainly way off of where we were a few months ago when we were up to 4.31 or 4.33, something like that. Let's see, gold this morning. Gold's been on a roll, by the way. I pointed out recently when it went through 1825, that was a significant short-term breakout. and it has continued to tack on a little bit more. We're up another $13 per ounce on gold to 1883 today. Anyway, that's just some of the pre-market stuff going on. Let me take everybody over to earnings beats and make sure, if you are new to earnings beats, that you're aware we do have a free newsletter. So just go down here, sign up, name, email address is all it takes. No credit card required. You can unsubscribe at any time. Again, completely free. 3 times a week newsletter, Mondays, Wednesdays, Fridays. So just had one out this morning. Actually, this morning I wrote about Visa. I think Visa chart looks pretty good. And we'll take a look maybe at Visa if I think about it before we end the show today. But I think Visa is looking pretty good, starting to show much more bullish characteristics after many months, probably 15 to 18 months of trending lower. It's now starting to look a little bit better and trend higher. So at least be aware of that. Hold on 1 second here. Okay, sorry about that. All right. So anyway, I just want to make you aware that we do have a free newsletter. Monday, Wednesdays, Fridays. By the way, it's just a 2-paragraph, 1 chart kind of a newsletter. It's not a lengthy newsletter or anything. Just giving you something to think about going into the trading day. It could be very educational in nature. It could be a setup for a possible trading candidate if you're so inclined. There's a lot of different things I like to focus on. Relative strength and earnings. I would say those are probably 2 of the biggest things that I like to focus on, but also trend lines, moving averages, candlesticks. So reversing candlesticks, sometimes I like to point those out. Price volume, just the typical technical analysis stuff. But anyway, go over to earningsbeats.com, sign up if you haven't already. All right, let's move on to talk a little bit about what happened to close out the first week of the new year. The Dow Jones Industrial Average was up more than 2%, 700 points, and you can see breaking out of this short-term trading range. So I like what transpired there. I mean, we had a nice move up, went back at that 50-day moving average, been trending kind of alongside of it, and then a really nice boost on Friday. Look at the AD line, strengthening, showing another new all-time high on the Dow. I think that's a bullish signal. S&P 500 was down below its moving averages, but finished back up above the 20-day on Friday. Still got some work to do to get through the 50-day, but maybe with today's pre-market move, maybe this is the precursor to a breakout above the 50. Next up, NASDAQ rising over 2.5%, 264 points, closing just beneath its 20-day EMA. But again, with futures this morning, looks like it's trying to make this move up. One word of caution. We do like to, consider all the bearish possibilities as well, even though I am not bearish. Going down on this downtrend on the NASDAQ, you can see kind of like this little left shoulder, neckline, triple top head, back down to equal neckline, and then we're moving back up. So you want to think, maybe around 11,200, 11,250, maybe 11,300. Watch for possible right shoulder. And then if we get a big selling episode and we break that neckline, which is down closer to 10,200, then we're going to have potentially some problems, in my opinion. Now, the NASDAQ has been the big underperformer in the last few months. So it's quite possible what we've been seeing up till now is money rotating out of the NASDAQ, but not out of the market. And that's a big distinction to make. And the reason we know that is look at the relative strength of the S&P and the Dow. They're not anywhere near their lows. So a lot of this money that's left technology and consumer discretionary and areas of communication services, that money's finding a home in other parts of the market. And that rotation is what is keeping the entire market from breaking down. That should be viewed as bullish. Until you see something different on the charts, I would view that as bullish. Mid caps up 2.4%, small caps up 2.3%. You can see the mid caps actually climbing above both the 20 and the 50-day moving average, very similar to the Dow, but those are the only two that are doing that at this point. Looking at the sectors, materials up 3.44%, technology up almost 3%, real estate up almost 3% as well, and industrials 2.75%, staples 2 2.3%. But all of these really made a big move on Friday. I would say the only one that still has a little overhead resistance to deal with is technology. You can see technology trying to get back through its 20-day moving average. If it does so, it's likely just to carry the NASDAQ with it on its shoulders. As I look across these sectors and I look at the AD lines, the only one I would say materials is still a little suspect because we did break out to new highs. We did not support that with a new AD high. Technology, however, has been going down for a while, but AD line's been pretty consistent. I would say real estate right now is probably the worst group. That one looks like maybe there's a bit more distribution that's taken place. But look at these last two. I mean, industrials and staples, AD lines are very strong, look pretty solid to me. So, and that's been one thing that I would say one of the indicators that tells me that this is cyclical more so than secular is that in a secular bear market, if you go back and you look at the prior secular bear markets, these AD lines completely fall apart. I mean, the selling usually is so intense in a secular bear market, you're not going to see AD lines going up. AD lines go up when the price finishes in the top half of the candlestick. In a secular bear market, you don't have folks buying in the afternoon. You just have selling throughout the day. You have a lot of distribution, and that should be shown with these AD lines going down. But instead, a lot of times you can see with the Dow, we had this big move down. The AD line went down a little bit. And then when we break back up and go back and test prior highs, the AD line goes to new highs. That's bullish. So one thing, again, something else to kind of think about. 10-year Treasury yield, currently 3.578%. We are up less than 1 basis point. Here's what I was talking about earlier, though. There's the higher yield up near 3.90% just recently. And what I had talked about while we were rising is, could we get back up through this level, which was about 3.9, 3.91. But we had gone down, we turned back up again, and then we went lower. Now we come back up here. We got up to about, that's 389, 3886, 3905, 3905, and there's 3901. So essentially we got right up to that level and then just started falling back apart. I mean, it looks to me like we're rolling over here. If the 10-year Treasury yield rolls over and starts to move lower, I mean, that to me is the bond market beating us over the head that inflation is not a problem. And that's the ghost, I think, that the Fed is continuing to try to chase. I think the Fed's talking tough. We'll see whether or not they continue to raise. Beginning to have my doubts a little bit, but we'll see. They have, I'll say last year when they said they were going to raise 9 straight times or whatever, I was like, no chance, 0 chance. And I was way off because they have raised every single meeting since then. So, you know, I believe based on what I'm seeing, they should be pausing their rate hikes. I'm not trying to say I'm smarter than the folks on the Federal Reserve. They're brilliant people. But based on what I'm pretty good at reading charts and understanding the story. And what I'm seeing is a bond market that is telling the Fed to stop. You don't buy a 10-year Treasury yielding 3.6% if you believe that we've got inflation problems ahead. You just don't. Why would you buy? Why would you get a 3.6% yield when you know inflation's over 6%? That makes no sense. Hold on. Okay, sorry. Still trying to deal with the remnants of this cold. I think everybody probably can feel it. It's certainly going around my area. Anyway, 10-year Treasury yield, like I said, rolling over. I think this is a good sign for the market. One thing that you can, well, I mean, I can guarantee you, I mean, I did valuations as a practicing CPA many, many years ago. But one thing I can guarantee you is that if everything else stays the same and all you have is lower interest rates, valuations go up. The market cap, the valuation of US companies goes up if rates drop. Now, that's not the only criteria. And so one of the things that's really driving the market, in my opinion, right now, the stock market, is the overhang of a possible recession. And how bad is it going to be if we have one? Well, I think the answer lies in big part from what the Fed does. Listen, if the Fed keeps going at it and keeps raising rates, there's already tons of weakening. I don't know if you saw factory orders on Friday. They fell 1.8%. The expectation was for 0.8%. They fell 1.8%. We're seeing signs that the economy is slowing significantly. Not seeing it so much in jobs yet. And that's what a lot of folks like to focus on, but we're seeing it in a lot of other areas. So, I mean, look at crude oil prices. I mean, that's more of a global kind of an indicator. Crude oil prices were up to $130 a barrel. They're now stuck down in the 70s. That's a really simple demand supply issue right there. Anyhow, let's keep moving here. So as I look at the S&P 500, here was the move back up through the 20-day moving average. Really nice breakout on Friday, not just above the 20, but this sideways consolidation. It was just good to see it start to turn back up. We had a nice little uptrend going. Is this a cup? You know, I pointed out on the NASDAQ a possible head and shoulder, and it's not a good head and shoulder. It's not a reverse head and shoulder that marks the bottom. It's actually the opposite of an inverse head and shoulder that you get after an uptrend, where you go up and you put in an inverse head and shoulder, which is a continuation pattern to the upside. And I'll show you this NASDAQ right now and show you what I'm talking about. This is instead a downtrend followed by left shoulder, neckline, head, neckline, possibly right shoulder. That's what we have to watch for. So that on the NASDAQ is a little bit of a bearish pattern. That does not confirm, however, a lot of folks see head and shoulders and they automatically assume, oh, that's bearish or that's bullish, depending on what kind of a head and shoulder top it is. It's neither. It's a pattern, and the pattern doesn't confirm until you execute the breakout. The breakout is this neckline. We have to go below this neckline. We need to close, and it would be helpful with big volume. So some news event, maybe Powell comes out and says something again, or we've got the CPI coming out this week. I don't know if you know, but Thursday, CPI will be out. December. It's been good news the last 2 months. Will it be good news again? Don't know. But if it's not, that could be a catalyst. We might go up for a few days and then get this catalyst and have that breakdown. It's possible. I don't have a crystal ball. I can tell you the Fed's watching it. So, they said once we started to see good news on the inflation front, that we, think about pausing. And then we got good news, and then they said, well, we need a series. It's not good enough. So then we got another one. And then we also had the wage component on, average hourly earnings on Friday, and the non-farm payrolls come out below expectations and half of what it was the prior month. Had a nice rally, but those types of rallies have been killed by the Fed. Now the Fed is like, well, we need to see, it was at first we needed some good news. Then we needed a series. And now we need to see that we're actually heading back toward 2%. I don't know what that means. I don't know how many series you need for that. So the big problem I have with the Fed is that they've been inconsistent with what they've been saying they want to see. And that leads to a lot of volatility in the market and a lot of whipsaw. Again, I called a market bottom in June. We were going up. It was the Jackson Hole speech right here that turned things around. I think the stock market said, well, wait a minute, what are you talking about? It's not what you had said before. Anyway, that's my take on it. You can disagree if you'd like. But I think the Fed, and I'm not looking for the Fed to be dovish and just start handing out money. That's, I'm not looking for the government to do those types of things. I'm just looking for the Fed to be consistent. Tell us what you're seeing, what you need, what you want to see. And then when it happens, follow through with what you said. Don't start changing the language. But anyway, that's the bearish side looking at the NASDAQ. But if we look at the S&P 500, this moved back up through the 20-day, and potentially this could be a really nice rounded cup off of an uptrend. This potentially is a bullish pattern developing. Now, again, doesn't confirm until you actually make the rest of the cup, till you probably put in a little handle and get a breakout. I will say, though, in 2023, I think for me, the biggest resistance level, if you want me just to point to one level where I say, hey, if we go through this level, it's over for the bears. In my opinion, if we go through 4110, I think it's over for the bears. That will start a pattern of higher highs, higher lows, another higher high. It also will break this downtrend line. I mean, these highs right here, if you connect this high, this one, and also back to the beginning of the year, it's almost a perfect trend line. Well, the trend line right now comes down probably around 4,030. So if you get through 4110, you're getting through a major area of resistance, plus you're getting through that trend line. I think at that point, with the other signals that I'm seeing, I think it would be over for I think the cyclical bear market at that point would be over. Now, the cyclical bear market doesn't confirm that it's over literally until you hit another all-time high. I mean, we could literally go back up to 4,700 and come right back down. You're still top. You still have a top way over here. You haven't broken down. So the bear market doesn't confirm that it's over until we actually see another new all-time high. And that could be much later in the year. It might not even be this year. I think it's going to be probably in 2024, but I wouldn't rule out 2023. And I know before I said, hey, we're going to hit a new all-time high this year. But I think some of those things I talked about with the Fed, I think just kind of pushed everything back a little bit. All right. So I thought what I would do here, since we still have another 7 or 8 minutes or so, I wanted to go through and talk a little bit about the relative strength, because this is technology. And this is why we're not seeing any strength in the NASDAQ right now. Well, this is one of the reasons. But right here, I mean, we are right now we had a relative low just at the end of last week, also one in October, also one back in May of 2021, also one back in July of 2020. And we have now tested this 4 times. It looks a little bit like a little bit of a head and shoulder top. Can't really use this as the right side of the neckline because you went back down a little bit below that. I don't like these uptrending slope necklines anyway. Like I know a lot of folks will point to these head and shoulders like this. I don't agree with that, because number one, when you break the neckline, you still haven't lost support over on the other side. So here we went right down to support and held and came right back up. Now we're back down. I think this is the more important neckline. If you break there, you've lost all support for the last 2.5 years on a relative basis. Anyway, so this is one that's worth watching, because this is one of those signals that if it breaks, obviously is more bearish. Technology is the largest sector in the S&P 500. It has the largest weighting by far. So if you're getting a relative breakdown to a 2.5-year low, I mean, I'm not saying that means the S&P 500 can't go higher, but you have your largest weighting that's pulling against you. You're not going to go screaming higher without technology. So this is a big one to watch. The other aggressive groups, you've got consumer discretionary. Here, I mean, it couldn't be much worse, right? I mean, look at this. Horrible. Money has been rotating. Now, keep in mind, too, that the consumer discretionary group, which benefited greatly from Amazon and Tesla in 2020 and even into 2021, setting a new high. those two stocks have been crushed in the fourth quarter of 2022 and into the start of this year. Well, we're getting maybe a little bit of a rally in them, but for a year, or excuse me, for 3 months, it was horrible. Those two stocks, and they make up about 45% of the XLY. So you get something that's almost half of an ETF, and it's going straight down. It's going to take the ETF with it. And so that's what we've seen there. So these are two big groups, and they don't look good. I mean, I'm not going to come here and tell you that this looks bullish. This looks awful. But normally when you see something like this, the market would be breaking down, and it's not. So yeah, we're losing a lot of money. Money's rotating heavily out of consumer discretionary and technology, but it's finding a home elsewhere. Communication services starting to strengthen finally. The first 20-week relative 20-week test that we have had in 15 months. It's pretty significant. All right, let's take a look at some of the industry groups. And I'm going to go through, excuse me. I'm going to go through and just talk about some of these that I know are strengthening. Well, first of all, look at restaurants. This is one that it's a head scratcher. Why is it a head scratcher? Well, we're being told we're going to have a bad recession. That's what the media keeps telling us. Horrible. It's going to be a really bad recession. The consumer is going to be crushed. And yet Wall Street is just pouring into restaurant stocks. Does that make sense to anybody? I mean, it makes no sense to me. I like to see restaurants doing well because that normally is a pretty good sign of the consumer. I mean, what else pushes restaurant stocks higher? Higher costs from inflation? I don't think so. That was a little bit of sarcasm toward inflation as well. I mean, food prices have gone up a lot. I'm not saying they haven't, but I don't think it's a long-term problem. And I think that's what the market is saying. Again, if inflation was a big problem and we've got a recession coming because we keep raising rates, those are two things that would drive restaurant stocks straight down. And yet, since March of last year, I mean, this has been one of the hottest groups in the market. How about, let's see if we can find another one here. Apparel retailers. I mean, look at apparel retailers. So again, think about technology and consumer discretionary going down. Actually, this is one of the consumer discretionary areas. So this is within the group that's going down. The overall group's going down because of the weighting, but you do see money rotating into other areas within the, consumer discretionary space. So restaurants was one, apparel retail is one, home construction, higher interest rates, right? Isn't that what we're looking at? Home construction taking off here. I'm not seeing any bad stuff there. Looks pretty good to me. How about furnishings? Look at furnishings after struggling for a while, now turning up and up to about, I don't know, maybe 10, 11 month relative high. How about footwear? Footwear going straight up now. And again, this just means that it's outperforming the S&P 500. Doesn't always mean you're going higher. S&P could go down 10% and an individual group goes down 7%. Well, it's outperforming. This line would go up, even though both the S&P and the industry group are going down. So don't confuse this. This is rotation. This gives you a good signal about what's happening in terms of rotation in the market. How about, I know one space that I really like right now is aerospace. I mean, look at this line. I mean, the last 3 months, technology, horrible. You know, those last 3 months, discretionary. Remember, I mean, Tesla and Amazon getting killed. Well, look at this. Aerospace is absolutely flying. And if you look at the absolute chart, look at this. It's coming down here in November and December. But the S&P was getting killed. Oh, wait a minute. That's actually, I don't know how computer services got down here. Yeah, because actually, I think Thought aerospace was going up. I know Boeing's going up. I think the overall group has been going higher. Yeah. So there are times, I mean, look right here. Here was a pullback in aerospace at the end of November, but look at the relative strength. It continued going higher. Why? Well, the market sold off a little bit, but aerospace actually sold off less. And so as a result, it was showing more strength. That's important during sell-offs to see what is going down less, because it is getting more than its fair share in terms of rotation. Then when the market starts to strengthen, look at the leadership take over. But look at aerospace now relative. You got to go back all the way to March of 2020 to see aerospace at this level relative to the S&P 500. That's good news. I mean, there are still really good places in the market to invest. Technology and consumer discretionary, not really the best. Although, like I said, there are areas within those groups where you can find some strength. I'll look at one more. Let's see if we can find one more. I think the insurance brokers are good. Yeah, let's go ahead and pull insurance brokers up. Yeah, I mean, they've been good for a while. But if you're looking for good trades on the long side, stick with areas that are outperforming the S&P 500. I think you'll have better success. All right, one chart I'll give you. I want to give you that Visa chart and show you what I was talking about there. So Visa market just opens. A Visa up again today, trying to make this breakout. I think it's going to make the breakout, to be honest, but we'll see. The PPO went back, reset at the center line, just starting to turn up again. This could turn out to be a cup. Maybe we get a little bit of a handle and then break out. That's very possible, but that looks good. But look at the 5-year weekly chart. That's what is starting to get my attention here. You've got this channel that's been going down for about, well, maybe 15 months or so. And then we broke the channel. And notice what happened when we pulled back. We back tested that channel breakdown and the 20-week moving average. And now we're turning up again. Look at the weekly PPO. Even when we pulled back for 3 weeks, that PPO didn't budge to the downside. Momentum is with the bulls right now. And I think Visa is going to make a run for its high from July of 2021. I think we're going to make a run for that 250 level. And as long as money keeps rotating the way it is, away from the NASDAQ and toward the S&P, more toward the S&P and more toward the Dow stocks and so forth, Visa, I think, is in a position to get a lot of that rotation. Anyway, that's what I had for today. So let's see what the market's doing, see if it's held on to its gains so far. Oh, yeah, NASDAQ up 1% today. Nice move, 110 points. Dow up 167, S&P up 25. All of this tacking on from where we were last Friday. So more strength. Remember, January, telling you, January affects a real thing. So we'll continue to see how we perform in January going forward. All right, everybody have a great day. I'll be back tomorrow over at Stock Charts TV. So at 9 a.m., just come on over here, click on that Stock Charts TV button, whatever there, and then you will be able to watch Trading Places live tomorrow. Here at Earnings Beats, I'll be back on Wednesday. Have a great day, everybody. Happy trading.